Well, hello everyone, and welcome to Arizona Sonoran Copper Company's live summit today, hosted by ASC'sU. I'm very pleased to introduce President, CEO, and Director George Ogilvie. George is going to walk us through a company presentation, and after we will be accepting questions live. So as a reminder, you can submit your questions at any time on the right-hand side of the screen, and we will get to them after the presentation. And as always, the summit is being recorded and available to watch afterwards on ASC'sU.com. But without any further ado, I'm going to hand it over to you, George, to kick it off.
Hey, great. Thank you ever so much, Dasha. And thank you for the opportunity once again to join you and the six listeners here today. So it's Arizona Sonora Copper Company, and the title of our presentation is Copper Invest in Sustainability. We do make some forward-looking statements, so I'll draw your attention to the cautionary language. Our share capital structure remains relatively the same, what we presented several weeks ago. Still only 71 million shares issued, 81 million fully diluted. Very strong treasury. Today we're sitting with approximately $14 million cash in the bank. And we're funded through until the end of the year in the delivery of a bankable feasibility study. Very strong treasury as well, balance sheet, only $1 million in debt, which is due to Tembo Capital. We currently have 4 analysts covering the company with a target price of $2.95 to $4 Canadian. We recently had an analyst tour to the property where 12 analysts came through the site about 10 days ago. And we would anticipate in the next 2 to 3 months that another 2 or 3 analysts would launch coverage on the company. Tembo Capital remains our largest controlling shareholder, and they're very supportive of the company and the management of the company. Thank you, Alison. A little bit on some of the events that have occurred in the beginning of this year. We recently announced that we'd received a JDS, which is a Jurisdictional Determination Survey. This was official confirmation from the U.S. Army Corps of Engineers that there were no waters of the United States, and therefore there is no federal permits required, and therefore no federal nexus on this project. I'm very happy to say as well that a couple of weeks ago, we announced that we had acquired our Aquifer Protection Permit. That was a major de-risking event because from the application date, which was mid-October, until the actual award of the permit, which was the 31st of March, that took approximately 5 months to be awarded that permit. And we went through a 30-day public consultation period where there were absolutely no concerns raised by the public. In order to improve liquidity, we also now trade on the OTCQX under the ticker symbol ASCUF. And we would see that over time, liquidity will improve as we get our DTC eligibility. But we see that over time as a stepping stone up to one of the main boards as we become a producer here in the next couple of years. Obviously, we've been putting out great results on Park Salyer, and we'll talk more about that. But we're definitely seeing something that's going to be very regional size scale, and that no doubt might attract various mid-tiers and senior base metal producers. The drilling program is still underway at the Cactus site itself. We're targeting infill drilling from indicated up to the measured category, ahead of a bankable feasibility study at the end of the year. And we're still on track to deliver our pre-feasibility study. Probably sometime the high-level results will go out in August of this year. And we're anticipating filing the technical report just after the Labor Day weekend in early September. Remember, the PEA told us that once the project financing was in place and the project was given a green light, it would be approximately 18 months of construction and development, and that would put us into first production towards the back end of 2024. And the company remains on track to execute on those plans. So the project's located 3 kilometers west of the city of Casa Grande. That Casa Grande has a population of 55,000 people. We maintain a very strong social license from within the city and the Maricopa and Pinal County. The project is 45 miles south of Phoenix with a population of 4.5 million in the greater Phoenix area, and 75 miles north of Tucson with a population of 1 million people. The site is very well serviced by roads and infrastructure, and indeed we have the main hydroelectrical line actually running right through the mine site. You may remember or know that Arizona ranks very highly on an annual basis on the Fraser rankings, and of course it supplies over 70% of the US domestic copper supply. So a little bit more on the permitting. When we applied for that permit in mid-October, within 5 days it was administratively accepted, which started a clock ticking. And we've always said that with no federal regulators, the state regulator must give us a response within 180 days, and that includes a 30-day public consultation period. And as I said earlier, on the 31st of March, we were awarded our amended Aquifer Protection Permit, which basically gives us the authorization to mine the surface stockpile, the pit layback, and the underground component while protecting the aquifers within the area. The other key permits, we're still on track to apply for those in the next couple of months. Those would be the construction and development permit and also the mined land reclamation permit. We can only apply for those once we have a line of sight on our pre-feasibility study, which obviously would be built from maiden reserves, and therefore we would have a lot more confidence in the plan. Assuming 1 to 2 months to have the applications administratively accepted, that would take us to July and August of this year, and then running through the 180-day process as described earlier means that in the first quarter of next year, we would be in possession of those various permits. The bankable feasibility study would be done, project financing would be lined up, and therefore we could start construction and development in the first quarter of 2023. So, as I alluded to earlier, we conducted a perception survey in December of last year. There were 500 respondents from the city of Casa Grande and Pinal County. This was a follow-up to a survey we conducted about 1.5 years ago with 400 respondents. And you can see on the page here that 83% of those respondents were in favor of seeing the mine coming back into production. And that was down slightly by 3% from the prior survey, which gave us an 86% favorable response. But the pollsters seem to think that these results were excellent, given that over the last couple of years with COVID in the US and the US politics with the Biden-Trump election, the general public in the US is a little bit more negative and skeptical and a lot more pessimism. And they felt that maintaining an 80+% favorable rating was extremely good. So we have a very good, strong social license from within the community and great support. Our land package obviously hasn't changed in the last several months, still 4,800 acres, but you can see there where we currently are drilling at Park Salyer. The mineralization trend runs from the bottom left-hand corner up to the top right-hand corner here. And of course, we picked up the Bronco Creek properties where you see that little 158 acres. We would anticipate that probably sometime in May of this year, once the initial 12-hole program is completed at Park Salyer, we now have the legal authority to put a drill onto the former Bronco Creek properties. And I would suspect that we'll be drilling there sometime from May of this year to see if that mineralization trend runs over onto that property. To the south of us, we have Robert Friedland and the Ivanhoe Electric Group, which is drilling immediately south of us and also south of the Maricopa Casa Grande Highway. We would expect, given that's a private company, that it'll come to the public markets sometime before the end of this calendar year. And given that organization is being led by Robert Friedland, we suspect it's going to bring a lot of attention to this district, which I think in the medium and longer term is going to be extremely positive for the Arizona Sonoran shareholders. So just to recap on the global resource, we have 3.5 billion pounds of metal in the ground in all categories. And that also consists of oxide, enriched, and primary sulfide, which we're not currently targeting at this juncture in time. So we have 73 million tons of 0.72 total soluble copper, giving us 1 billion pounds of leachable material in the indicated category. And then in the inferred category, the grade is slightly lower at 0.42 total soluble and 980 million pounds. That's the infill drilling that we undertook last year and that completed in February of this year. We would expect in the next 2 to 3 weeks to have received all of the remaining outstanding infill drilling from last year's program, and those results will come to the market. And they're important because they're going to feed into the PFS and an updated resource statement, and of course maiden reserves that will be part of the pre-feasibility study. Just a reminder on the economics, we ran the resource at $3.15, and the copper, the financial and economic model was ran at $3.35. Essentially, we had an 18-year mine life and 56 million pounds of copper cathode produced annually. It's early stages yet within the PFS, but we are seeing a little bit more of a robust production plan at this early stage. Our C1 cash cost in the PEA was $1.55, and the all-in sustaining cost was $1.88. After the initial capex, we saw 16 years of sustaining capital at $340 million US. Now, on the capital, we are seeing an increase in capex within the PFS as expected. Some of that is due to inflationary pressures, and some of that is going to be due to some additional fixed assets that weren't included in the PEA, namely a primary crusher, secondary crusher, and we're looking at conveying and stacking the material on the leaching pad and not running big trucks up on the leaching pad where the porosity and permeability can be badly affected through compaction. On the economics, at $3.35 a pound of copper, remember the NPV 8 after tax was 312 million, and the IRR after tax was 33%. Since our last discussion on this platform, the copper prices have remained well above $4.50 a pound, which would put the economics of this project on the extreme right of the page, and therefore we'd be looking at a NPV 8 after tax, well in excess of $600 million US, and an IRR above 50%. Now we come into Park Salyer, and I'm sure you've been following the exploration results of this program. They've been extremely exciting. Just to recap, ASC'U drilled 2 historical holes, S200 and S201, which are highlighted in the upper right-hand quadrant of this slide. About 15 months ago, the company drilled 2 holes, number 18 and 19, 800 feet north of those 2 original holes, and went through the same massive copper porphyry system. And again, those results are highlighted on the right-hand side. And then in December of this year, we announced that we were embarking on a $3 million US exploration program, specifically at Park Salyer, where we would drill an additional 12 holes. 2 of those holes had been drilled in December, early January. The results went to the market in February, and those are holes number 45 and 42 that you can see on the screen. And then approximately a week ago, we had received 2 follow-up holes, which would be number 57 and 65, and we put those out to the market. And since then, 3 other holes have been finished. The core has been logged and split and prepared and sent off to the laboratory. So we're waiting on the results for those 3 other holes. And I believe there's another 4 to 5 holes still to be drilled, and we would expect that drilling to be completed sometime before the end of April. And that's where then upon we would move on to the Bronco Creek properties. But as you can see in all of the holes, we've gone through some significant oxide. The enriched material looks extremely exciting. We've gone through hundreds of feet in all of the holes of somewhere in between 0.9 to 1.3 total % copper. And there's obviously some significant molybdenum as well associated with the enriched chalcopyrite chalcocite material. And then, although it's not part of our current mandate, we've been drilling these holes the full extent all the way down to the basement fault. That's adding in another 400 to 600 meters of primary chalcopyrite, which is not currently part of the plan, but we do see an opportunity at some juncture down the line that some form of trade-off study is going to be done, particularly at these copper prices, as to whether we look at going back to a conventional flotation mill to actually process some of the primary sulfide at a much later stage in the project and the company's growth profile. Thank you, Alison. So we've conducted geophysics, geochemistry, sonic soil sampling on Park Salyer. We end up with a strike length of about 1.2 kilometers of open ground. Width-wise, in plan view, we're looking at something that's over a kilometer. And the top of the mineralization generally occurs about 300 meters down the hole and continues on till about 600 to 800 meters down the hole. So we've got 500 to 600 meters of vertical intercepts of mineralization. We took a volumetric calculation and then we reduced it by 50% in order to be conservative. We took the 6 holes that had been drilled at that time and we know the specific gravity, and that gave us a volumetric calculation of 40 to 90 million tons that might be sitting there of leachable material between 1 to 1.3% copper, which would yield an additional 1 to 2.3 billion pounds of copper in the ground. Over and above that, there's the potential for an additional 150 to 750 million pounds of primary chalcopyrite copper in the ground. If we add the two, we're looking at somewhere between 1.2 and potentially up to 3 billion pounds. And that's on a 50% volumetric calculation. So if we were to add that to the current resource at Cactus, if management can execute on its plan at Park Salyer and what we hypothetically believe could be there, I believe in the next 12 to 18 months, the company could easily be looking at additional, or in the region of 5 to 10 billion pounds of copper actually sitting in the ground. And then if we look on section here on the extreme right-hand side, you can see hole 45, which we put out there in February. The most significant mineralization there was 595 feet at 1.2% total copper. And you can see the molybdenum associated with that as well. One of the new holes that went out last week, hole number 57, you can see that just to the left. And there, you know, the most significant mineralization was 302 feet at 1.23% copper. And then if we swing over to the left-hand side, you'll see hole number 65 that went out last week, 439 feet of enriched material at 0.92% copper. And even in the oxide cap, we went through several tens of feet, but some really nice grades of well over 1%, approaching 2% in some cases. And then just to draw your attention to it so you can see it in a pictorial format, if you look down at the bottom in the dark blue gray area, you can see 600 feet, 400 feet of 0.2 plus % of primary chalcopyrite material that's not currently part of this existing plan, but certainly could be an option if copper prices remain on a go-forward basis at these type of levels, if not higher. And then in section, this is over a full 4 kilometers of strike length. I think another opportunity the company has that we'll start turning our attention to sometime towards the end of the year, given how much we have on our plate just now with the main Cactus project in Park Salyer, would be the northeast extension. Again, here, ASC'U drilled historically into that extension. They hit the copper porphyry system. Many of the holes were not drilled to the full extent down to the basement fault, and therefore we haven't picked up the full extent of the primary chalcopyrite there. But I do believe there's an opportunity that when we start exploring there, we're going to find the same copper porphyry system, and it'll all be connected to the Cactus East, which ultimately we see within the PFS, P.Eng PFS, as an underground mine. The other thing to note here is that immediately below the pit, ASC'U only drilled a couple of 100 feet into the primary sulfide. Since acquiring this asset, our focus has been on the oxide and the enriched chalcocite material. So therefore, any drilling that we've done in around the pit has not drilled the full extent of the primary sulfide to the basement fault. So there exists the potential below the pit for many, many hundreds of feet of primary chalcopyrite to extend all the way to the basement fault. And I think if we start to consider that as a reality, I think, you know, we're going to be pushing upwards of 10 billion pounds here across this entire 4 kilometer of strike length as we drill the deposit out over the next 12 to 24 months. And just on valuation, remember the current PEA has 56 million pounds of copper cathode production. We're expecting that to increase within the PFS. Ultimately, at the end of the day, we see ourselves getting up to 80 to 100 million pounds of copper cathode production. Right now, the company only has an enterprise value of just under 100 million US dollars. If we could get up to that type of production profile and compared ourselves to a Copper Mountain, you can see their enterprise value is in and around 580 million US dollars. So I think if management can continue to de-risk the project and execute on our plan, I think there's significant upside from these levels today where we still trade around $2.20 Canadian with a market cap of only 150 million US dollars. There's definitely significant upside for both the existing shareholders of the company and any potential new investors looking at an investment in Arizona Sonoran. So just to recap on the why ASCU, obviously it's a brownfield site. It's in a tier 1 jurisdiction. We have 1.6 billion pounds of copper in the indicated category, and that's supported by 1.9 billion pounds in the inferred category. The PEA revealed very robust economics. For the PFS, we do expect the CapEx numbers and the operating costs to increase in these inflationary times. However, we are going to have the advantage of using slightly more robust copper prices than the $3.15 a pound we used to calculate the resource 18 months ago, and the $3.35 which we used for the financial and economic model. Remember, the entire land package is on private land. There's no federal nexus. That completely simplifies and streamlines the permitting process. And I think we've demonstrated in the last couple of years in the permits that we have achieved, they've been granted in very quick order. And there's been no major public concerns over the last 2 years with the permitting of the project. The infill drilling program, we believe, will be successful in converting inferred material over to the indicated category ahead of the PFS. And we're now embarked on a similar program this year for indicated up to measured ahead of the bankable feasibility study. And we're starting to see some significant exploration success. For example, if we could add, let's say conservatively, a billion pounds of additional copper in the ground at Park Salyer, if the company was only given a 5 cents per pound of copper in the ground valuation, that would be 50 million US dollars. It doesn't sound like much, but on 150 million market cap today and only 70 million shares issued and 80 million fully diluted, it can add significant value on a per share price basis for the shareholders of the company. And I think just lastly, one thing to touch on, I think everybody understands the fundamentals of demand and supply when it comes to copper. It's obviously a sad situation in Ukraine and what's happening in Eastern Europe. But I do believe that the westernized countries of Europe will now accelerate their decarbonization thesis, and the drive for renewable energy will become even more apparent very, very quickly as the West tries to remove themselves from Russian oil and gas. And I think that's going to create one hell of an amount of demand for battery type commodities. And obviously copper is going to be absolutely fundamental to the whole green energy space. And therefore, I believe that we're in the right commodity. It may take North America a little bit more time to catch up, but in the long run, the decarbonization thesis that has started with the Biden administration is going to catch fire here in North America. So that concludes the formal part of the presentation, and I'm very happy now to open up the floor to any questions that we may have.
Great. Thank you so much, George. There's a bunch of questions that have come in, but if you do have a question and haven't submitted it, feel free to do so now. What is the overall tonnage of copper expected at Park Salyer?
Well, as we said in the presentation, it's a bit of a kind of an extrapolation of what the possibilities could be just based on the geophysics and the sonic soil sampling. But when we do our volumetric calculation, right now we are calculating that there's between 40 to 90 million tons of potentially leachable material at Park Salyer. And when we take the sort of average grade, which is in and around 1% to 1.3% total copper, we know the specific gravity of the ore. That would give us somewhere between 1 to 2.3 billion pounds of additional copper that could potentially be in the ground at Park Salyer that's leachable. And then when we consider the primary sulfide, which is a chalcopyrite, over the same sort of volumetric calculation, much lower grades, however, at only sort of 0.2 to 0.4, I think we're in and around about a 0.35 is the weighted average grade, would give us somewhere between 150 to 750 million pounds of additional copper that might be present at Park Salyer in the primary sulfide. So, you know, compared to a £3.5 billion resource right now at Cactus, I mean, essentially there's the ability there to double the resource in the next 12 to 24 months as we aggressively drill out Park Salyer.
Great, thank you. And a question here is, are copper prices likely to plateau, and how quickly do the copper prices changes affect Arizona Sonoran Copper's value?
Well, my thesis, I mean, predicting commodity prices is very, very difficult, and no matter what I say here, it won't be the right answer. So this is just George, thinking. But I think that the copper prices probably have been supported of late because of the supply chain disruptions. We are seeing a general slowdown in the economy, which is what you would normally expect copper prices to fall. But I think because of those supply chain disruptions and inventories being quite low, both on the London metal exchanges, the various bonded warehouses, and obviously in Asia, I think that copper prices going forward are likely to stay at these levels, or certainly well above $4 a pound of copper. And if you may remember back to the presentation, we ran the base case PEA at $3.35 a pound of copper, and that gave us an NPV using an 8% discount factor of $312 million after tax, and an IRR after tax of 33%. If you run the numbers today at spot prices, which is around $4.70, the numbers go well in excess of $600 million US, and the IRR after tax is approaching 60%. We, as I alluded to in the presentation, we will see capital cost increases in the PFS, which was always expected. And we will see some operating cost increases, as sulfuric acid is a big operating cost, and on a per ton basis that has gone up in price due to supply chain issues. But we will have the luxury, or be fortunate, to use a more robust copper price. So I believe that for the PFS at the moment, we're looking at a $3.50 copper price for reserve calculation. And I believe long-term copper pricing, there's 40 to 50 banks that cover the copper space. Right now, they are forecasting $3.65 long-term copper price, which obviously is over 10% above the $3.35 that we actually used within the PEA for the financial and economic model.
Great, thank you. Lots of questions here. So Richard is asking, what is the history of the Friedland local investment? Was he before or after Arizona Sonoran?
Yeah, Arizona Sonoran, as far as I know, was first in the area, we acquired this asset, which was formerly known as the Sacaton Mine, from a state trust that was being managed by the Arizona Department of Environment and Quality. And the former management, my predecessors, were able to acquire the asset from the state trust by paying the state of Arizona $6 million US dollars. And that occurred late in 2019. It was after that date in time when Ivanhoe Electric and some of their subsidiaries was able to acquire the property south of us and south of the Maricopa Casa Grande Highway. That area is known as the Santa Cruz Wash. There are several deposits on that property. One of them is known as Hanageti. The other one is known as Texaco. We know of these deposits because they were drilled by ASC'UF back in the 1970s and 80s. And subsequently, when we acquired the asset from the state trust, which was a former ASC'UF mine, I believe we did inherit some of the old database from the Santa Cruz Wash area, and specifically Hanageti and the Texaco deposits.
Thank you. Harry's asking, what is TSOL and why do you use this metric in lieu of copper equivalent?
Well, the TSOL basically refers to the total soluble percentage content. That's a better metric for us, given this is a heap leach operation. So, at the end of the day, from the column test that we've conducted to date, we see using a copper acid soluble, we get about a 90% recovery of copper from the oxide. And then when we look at the enriched material, which, as I said earlier, is a chalcocite, we have a copper cyanate, and we see anywhere between a 73 and a 78% recovery of the copper within the enriched material. So it's all related to copper in solution. Once we have this pregnant leach solution that we capture within the leaching pad, and then we pump off into the solvent extraction electrowinning plant, not all the copper is recovered from the run-of-mine ore, which is sitting on the pad. It's not like a copper concentrator. So we take it from that copper that's in solution in the pregnant leach solution, and that's why we use total soluble copper is more relevant for a heap leach operation.
Great, thank you. Another question from Harry is, could you kindly discuss what impact acid availability and prices have on the OPEX and development plans? Would you be able to more economically produce your own acid if needed?
Yeah, that's a great question. So when we conducted the PEA over 18 months ago, it went out in August of last year. We were using a sulfuric acid cost delivered to site of $120 US a ton, which was appropriate for that point in time. We had an acid supplier in on site 2 to 3 weeks ago, and they gave us a quote today of $220 a ton acid delivered to site. Now, we're several years away from putting the mine into production, but we will have to secure an acid source at some juncture next year as we complete the bankable feasibility and the project financing. And long term, we're being given prices of about $160 to $170 a ton. So that's still about a 40% uplift from the $120 a ton that we were using within the PEA. So one of the things that we're trying to do within the PFS is that because the underground ore only comes in years 5 and 6 with full production in years 8 and 9, because it has higher grade and there's a higher pyrite content, we actually see when the enriched material from underground goes onto the pad, it self-generates very weak sulfuric acid. So we end up in the mine's latter years with an excess of sulfuric acid. But that's not really when we need the excess of sulfuric acid. If we could move that forward, it would help lower the operating costs in the mine's earlier years. So one of the things we're now considering within the PFS is that from day 1 to year 5, we would mine the surface stockpile. That's obviously generates significant free cash flow for us. But rather than go after, in the first 5 years, a pit layback, which is capital intense, and then mine lower grade open pit material, which requires the addition of purchased sulfuric acid, we're looking at taking the capital allocated to the pre-strip and reallocating that to the twin declines that would go into the underground workings, not in year 5, but starting in year 1 of the current production profile. And essentially what we're doing is we're replacing marginal material within the pit at these higher operating costs with a higher margin material from underground because it has significantly better grade, and it lowers the operating cost because it self-generates a weak sulfuric acid. When we put that into the model, what it also does, it gives us a better metal plan over the mine's first 5 years when compared to the PEA. And that's quite important when it comes to the project financing, because any debt financier will look at particularly the first 5 to 6 years, which is generally the term of the loan, and they'll want some assurances and be highly confident that they actually can be repaid their monies. And if we have a more robust metal plan with lower operating costs and therefore better margins in the mine's first 5 to 6 years, the likelihood of putting that project debt financing in place increases significantly. So that's how we're sort of playing with the options that we have. And the good news is we have a lot of optionality. We're also speaking to a few strategics out there that do generate themselves sulfuric acid from their own smelters. And obviously, the sooner we can engage in conversations with them and hopefully gain access to sulfuric acid, I think the better it's going to be for the project. And as I said, I think early 2023 is probably when we'll be looking to put those contracts in place, about 18 months out from first production at the back end of 2024.
Great, thank you. Stephen's asking, how are you looking at crushing the material on the leach pad? Is it a single stage or a 2-stage crush?
Well, again, that's a great question. This was a bit of a lacking in the PEA. So in the PEA, we were taking run-of-mine ore from the underground and from the pit, which typically would be 6 to 12-inch minus, and it was then being trucked onto the leaching pads. And as we did now detailed engineering, and within the metallurgical laboratories, we're obviously looking at size fragmentation. We see that as the material gets smaller, we think between 1 to 2-inch minus is the optimum size. We see better recoveries. So at 1 to 2-inch minus, that therefore means we're going to have to put in a primary crushing plant and probably a secondary crushing plant. And that's part of the reason as well why the CapEx numbers will increase in the PFS, given that those fixed assets were never built into the PEA. The other thing that we're doing is that rather than trucking and depositing ore on top of the leaching pads through truck dumping, which causes a lot of compaction, and we therefore have to rip like a farmer plowing a field, the top 5 to 10 feet of those leaching pads, we're going to convey the crushed material and then stack it onto the leaching pad so that no equipment actually drives on top of the leaching pad. So again, that's either an additional capital cost, or we might consider bringing in a contractor with the crushing equipment, with the conveying and stacking equipment, and they would actually do that work for us. And of course, that would then go into the operating costs. So that's been identified in the PFS as a missing, and it's definitely being built now into the plans as far as for the mineable reserves and how we plan to mine this deposit on a go-forward basis.
Thank you. Dale's asking, why is ASC'U no longer involved and sold the site?
Yeah, so the history of this asset was that it was discovered in the late 1960s It went into commercial production in 1974, and then the mine closed in 1984, not because there wasn't significant mineralization in the ground, but at 60 cents a pound of copper, the mine was uneconomical. ASC'U was sinking a shaft at the time. They encountered water in the basement fault, and they were having to do a lot of cement drilling ahead of themselves, and therefore the progress in this shaft was quite slow, and it was taking up a lot of dollars for them. So they ultimately decided to close the asset in 1984. ASC'U kept the asset, and then in 2004, they ran into financial difficulties and they filed for Chapter 11 bankruptcy protection in the US. At that time, a lot of their assets were acquired by Grupo Mexico, and they're actually still mined in the US today. But this asset was not acquired by Grupo Mexico, and it therefore fell into a state trust. There was still remediation at that time required on site to close up the mine. So ASC'U and the administrator gave the Arizona state $20 million US to remediate the site. And that money was essentially spent by the Arizona Department of Environment and Quality, which is one of our main regulators on this project. And they were the ones who gave us recently approved or granted the amended Aquifer Protection Permit. So the site's been relatively fully remediated, and the good news is we're not responsible for any small environmental legacy issues that may remain, but there aren't many. And that's how the company came to acquire the asset from ADEQ in late 2019. And that's why today ASC'U is not involved with this project, given it fell out of the company's asset list when they went into administration in the early 2000s.
Great, thank you. Another question here. What is your current cash position, and how far will this get you on your roadmap for this year?
Yep, so the current cash position in the company is approximately $14 million US. We're funded through till the end of the year and the bankable feasibility study. Within that $14 million, we did indicate to the market at the beginning of this year that there was $3 million being allocated to Park Salyer and the exploration campaign. We would anticipate that the $3 million on Park Salyer will be spent, including all the assay data, sometime in May and June of this year. So it's looking like later on in the year, we might want to raise some additional monies to aggressively drill out Park Salyer so that we can bring it into a compliant resource at some juncture for the bankable feasibility study. The plan would be to bring Park Salyer in as a compliant resource, probably in the inferred category within the bankable feasibility study at the end of this year.
Perfect, thank you. Dale's asking, have you decided on a construction or engineering company?
Yeah, on the engineering company, as far as the technical reports are concerned, we continue to use the same groups that assisted us for the PEA. So that would be Stantec Engineering, principally their Phoenix office, although I believe they're also pulling expertise from their Salt Lake City office and Vancouver. And then within Nevada, we're using another group called Samuel Engineering, which is doing all the metallurgical work for us. So they did the PEA, they will do the PFS, and then, as I said, hopefully we can roll into the bankable feasibility study at some juncture in late summer here. We haven't gone as far as looking at EPCM groups for a full turnkey project if we decide to greenlight the project on the back of a bankable feasibility study and project financing. But I'm quite sure, probably sometime after the summer, we'll be having those discussions internally within the company.
Great. Thank you so much. Another question here. What is the status of alternative leaching strategies? For instance, the jetty resource process Are you evaluating and testing these? And do you expect alternative leaching methods to be a part of the upcoming financial studies?
Yep. So we have engaged with Jetty Technologies under an NDA. We have sent them a bulk sample last year in November. We are anticipating sometime before the end of May that we'll receive the first report on what we're calling phase 1 testing. There is another group which has now approached us for further testing. They also claim to have patented technology for the heap leaching of a primary chalcopyrite sulfide. And they also believe that the 73 to 78% we're seeing recoveries of the enriched material through a bio-leach. They believe their patented technology could potentially improve those recoveries as well. So there's a second bulk sample going off with this second group. But we wouldn't expect to get the results back from that other group probably sometime until after the summer of this year. What that means is that for the PFS, we won't have any of those results or opportunities built into the pre-feasibility study. But depending on how the testing goes, there might be the ability to build something into the bankable feasibility study as an opportunity or some blue sky potential. The sort of heap leaching of a primary sulfide is a sort of holy grail in the copper space. A lot of people have been experimenting and trying this for quite a few years now, and I don't think we're quite there yet. But certainly for old mine sites that already have, material that's drilled and blasted and sitting on surface, similar to our oxides and enriched material, I certainly think this technology would work for those operations, given that there's already a significant sunk cost in what you could deem as a waste pile, although it does have economic value. I think I touched on this earlier, but certainly if the copper prices remain at these levels on a go-forward basis and the investment community starts to get comfortable that $4.50 plus or $5 plus copper is the new normal, this company will definitely have the option at some juncture down the line to consider a trade-off study to look at putting in a traditional copper concentrator and eventually going and mining the primary sulfide through a copper concentrator again, particularly, as I said, at $4.50 plus a pound of copper. But that's not our initial plan here. But it definitely is an option on the price of copper at some future juncture.
Great, thank you so much. Another question here. What is the general experience for acid consumption for similar ores? Any insight from metallurgical studies done by others?
Yep, so we've been conducting bottle roll tests and the column tests now for well over 2 years. I believe for the enriched material, we're seeing somewhere in and around sort of 12 to 16 liters a ton on the sulfuric acid consumption. And then for the oxide material, it's anywhere between sort of 18 to 22 as the number. When compared to other heap leach operations in Arizona, for some of them that is a little higher, and some others that's a little low. So we seem to be right in the range of what comparable operations are seeing, certainly with copper porphyry systems for oxide and the same similar style ore within Arizona.
Great. Another question here. What tax rates have you used in the NPV calculations?
That's a good question. I don't know what the tax rates are off the top of my head, but I can tell you that we have factored tax into the numbers, both local municipal tax and state tax, and then federal tax. So the numbers have been checked by external tax accountants, and those would have been signed off within the P.Eng. So I've got to believe that the numbers are reasonable and fair. And then, of course, when we come to the PFS, we'll be building in the tax component as well.
Great, thank you. Mike is asking, given high NPV and relatively modest current market cap, any thoughts on the approach to minimize equity dilution for an initial capex given inflation, please?
Yeah, I don't know the exact split at the moment because we really need the mineable reserves and we need to see, the sort of metal plan. But we believe it'll be a little bit more robust than what we're seeing within the PEA, which was 18 years and 56 million pounds of copper cathode production annually. So, I think the nice thing is with this project is we are going to be able to put debt on the project. As you're all aware, the company only has $1 million of debt right now. And I would expect before the end of the year, we would be paying that debt off so that when we are negotiating with the project financiers, particularly on the debt, we're negotiating with them being debt-free, which is important. But, if you think about a typical 60% debt to 40% equity on a sort of $150 million, let's say, capex spend, that would be approximately $60 million in equity that would have to be raised, and 60%, the remaining 60% would be in debt. I definitely think with a plus 15-year mine life and the robust economics that we are looking at here, and I think we're in a very safe jurisdiction. I think copper is a great commodity to be invested in at this stage. So I would be confident that we can get the project financing and the debt component in place and therefore minimize the dilution for the shareholders of the company. An additional $60 million in equity, if we were doing that at a, let's say, $3 share price, it would be an additional 20 million shares on top of the 70 million we have issued today and the 81 million on a fully diluted basis. So be confident we could put this into production for somewhere between 100 and 120 million shares issued and outstanding.
Great. Well, George, we're approaching the end of the hour, so I just wanted to say thank you so much for taking us through the presentation and the live Q&A, and also thank you to everyone who joined and asked all of these great questions. If you do think of any questions following the summit, feel free to reach out to the company directly. There's more information on their website, of course, which is arizonasonoran.com. And of course, this is also being, the recording is being uploaded on 6.com to watch again following the summit. But I'll pass it back to you if you should have any closing remarks.
Hey, thank you, Dasher, and thanks to you and Six for the opportunity to present here today. I think this is the fourth or fifth presentation that we've made in a relatively short period of time since we became a public company in November of last year. And I would urge the listeners on the call today to go back to those previous presentations and really listen to what management said they were going to do. And I think you'll see that there's a common theme here in that we said we were going to do one thing and we've actually delivered on it. So the takeaway should be that the company continues to de-risk this project. We can continue to execute on our plan. That's not going to change. And I believe that these current share prices and company valuation, there's a hell of a lot of uplift for the shareholders of the company over the next 2 to 3 years as management continues to execute on this project.